If you do not understand gold, then you do not fully understand what has been done to your money. That is not a dramatic line. That is a diagnostic line. Most people think gold is an opinion, a taste, a hobby for cranks, doomers, survivalists, old men with safes, men who do not trust central banks, and people who enjoy talking about Rome while nobody asks them to. That is not the way I think about it. Gold is not a hobby. Gold is a test. It is the simplest test I know for whether you understand the difference between money as a store of purchasing power and money as a political promise. Most people have never been taught that difference. They are taught to think of money as whatever the government says it is. A dollar is money because the dollar is in your pocket. In your account, in your paycheck, in your mortgage statement, in your stock portfolio, in your tax bill, it is so integrated into your life that you stop asking what it actually is. That is how systems protect themselves. They do not win by persuading you every day. They win by becoming the background gold ruins that comfort. Gold forces the question. What is money when you strip away habit, national loyalty, and official language? That is where the conversation becomes useful. Let me begin with the first mistake almost everyone makes. They think gold is an investment. Sometimes it is talked about that way, marketed that way, speculated on that way, and traded that way. But if you stop there, you will misunderstand everything. An investment, in the most ordinary sense, is something that produces cash flow. A business earns, a bond pays, a rental property generates rent, a productive farm yields crops, a stock is a claim on future profits. Gold does none of that. Gold does not grow revenue. It does not invent products. It does not delight customers. It does not sign contracts. It does not wake up in the morning determined to increase shareholder value. Gold just sits there, and yet for thousands of years human beings kept returning to it. Why? Because gold is not best understood as an investment. Gold is best understood as money with memory. That is the first mechanism. I call it the memory metal. The memory metal is the asset that does not need a management team, a central bank, a policy committee, a treasury department, or a promise from a politician in order to preserve what it is. It does not corrode away the way iron does. It does not decay into uselessness. It can be divided, shaped, stored, transported, buried, remelted, inherited, and recognized across language, religion, dynasty, and empire. It carries purchasing power through time. Not because it is magical, but because it is scarce, durable, and outside the reach of ordinary political convenience. That is why people chose it. Not because it was shiny, because it was disciplined. Most people are never taught to respect discipline in money. They are taught to respect flexibility. Modern governments adore flexible money. Flexible money can be expanded, redirected, backstopped, diluted, rescued, and politically justified. It can be moved into war, debt finance, industrial subsidies, bond stabilization, bank rescues, asset support, and whatever emergency the age needs. Gold is the opposite. Gold is rude. Gold says no to convenience. Gold says there are limits. Gold says if you want more claims, you must face some external constraint. That is exactly why sophisticated systems tend to outgrow it in public and secretly fear it in private. People often speak of gold as though it were an old superstition that humanity matured beyond. I find that backward. Gold is not the superstition. The superstition is believing that pieces of paper or digits on a screen, detached from any hard anchor, will be managed with sufficient restraint that savers can trust them over generations without political abuse. That is the real leap of faith. Gold requires no faith. Gold requires recognition. Now, if you want to understand why this matters today, you must understand what happened when money stopped being a receipt and became an instruction. For a long time, especially in the modern imagination, the dollar was not merely paper. It was a proxy, a stand in a more convenient claim on something harder beneath it. A receipt is not the warehouse. It is a ticket to the warehouse. That distinction matters. A receipt can circulate because people trust the thing behind it. But if you can issue more receipts than there is substance in the warehouse, then a terrible temptation enters the room. You can start governing through promises rather than through reserves. That is what all fiat systems flirt with, and some of them do much more than flirt. The moment that still matters most in this story is 1971. That is when the last clean public fiction was severed. The United States closed the gold window and formally ended the convertibility of dollars into gold for foreign governments. People talk about that as if it were an administrative detail. It was not an administrative detail. It was a civilizational announcement. It said, in effect, that the discipline beneath the paper would no longer discipline the paper. From that point forward, the dollar was not a warehouse receipt. In the old sense, it was a claim resting primarily on state authority, taxation power, military power, financial depth, legal enforcement, and confidence. That confidence was enormous. Still is in relative terms, but confidence and restraint are not the same thing. And once restraint becomes political rather than physical, the incentives change. That is the second mechanism. I call it the broken anchor. The broken anchor is what happens when money remains socially authoritative after its hard external discipline has been removed. People continue using the currency, prices continue being quoted in it, contracts continue being settled in it, payroll continues flowing through it. Nothing looks dramatically different in the first week, or the first year, or sometimes even the first decade. That is what makes the break so dangerous. Life continues, the calendar moves, children go to school, mortgages are signed, groceries are bought, the anchor is gone, but the ship is still moving. Most people therefore conclude that the anchor was never needed. That is how monetary decline hides itself. Not in immediate collapse, in normality with a slow leak. This is why inflation is so often misunderstood. People think inflation means prices going up. That is how it is experienced, but it is not the deepest description. Prices are only the symptom. The deeper event is currency dilution, more claims chasing the same reality, more units of money against a world that did not expand as quickly as the claims did. Inflation is what the public sees when the state, the banking system, and the credit structure enlarge the claim side faster than the underlying world of goods. Labor, land, energy, and useful scarcity can support without repricing. Gold exposes that gold does not need to do anything dramatic. It only needs to remain itself while the currency around it loses discipline. This is why I do not like hearing people say, gold went up. That sentence is often backward. Sometimes gold did not go up at all. Sometimes the measuring stick went down. If a Roman officer could buy quality clothing, a belt, footwear, and the marks of status with roughly an ounce of gold, and if a modern person can still translate an ounce of gold into a high-quality suit, shoes, and belt, then what exactly changed? Gold changed very little. The paper changed. The claim system changed. The measuring stick kept shrinking while the metal kept sitting there, refusing to cooperate with the story. That is the third mechanism. I call it the purchasing power mirror. The purchasing power mirror is the ability of gold to reveal whether your currency has retained real substance across time. Stocks can go up for many reasons. Property can go up for many reasons. Wages can go up nominally for many reasons. Gold is different. Gold does not flatter policymakers. It does not care about speeches. It does not care about election slogans. It does not care how elegantly inflation statistics are presented. It simply reflects the long arc of trust and dilution. That is why people who do not understand gold often do not understand what happened to their savings. They think they saved. In nominal terms, perhaps they did. But if the unit of account was quietly being diluted year after year, then what they really did was hold a claim that required discipline from institutions that had growing reasons not to be disciplined. That is the tragedy. The saver thinks in numbers, the system thinks in elasticity. And when those two worldviews collide, the saver usually loses. Now let me make an observation many people do not like. Fiat currency is extraordinarily useful. That is true. Flexible money can help absorb shocks, finance wars, stabilize banking systems, lubricate enormous economies, and support political states that would struggle under older disciplines. I am not a child. I understand why governments prefer it. I understand why economies built on debt and public promises prefer it. I understand why central banks treat it as a feature rather than a flaw. But usefulness does not erase consequences. In fact, the great danger of fiat systems is that their usefulness at the top often turns into quiet punishment at the bottom. If money can be created more easily than before, who benefits first? Not usually the saver with a checking account, not usually the pensioner living carefully, not usually the worker whose wages lag. The first benefits tend to go to those closest to credit creation, asset ownership and institutional channels, banks, governments, large borrowers, asset markets, holders of leveraged claims, people who own houses, stocks, land, businesses, and scarce things. Meanwhile, the cash saver is told to be patient, while the purchasing power of patience gets shaved. That is not an accident. that is one of the distributive features of the system. This is the fourth mechanism. I call it the dilution ladder. The dilution ladder is the order in which fiat expansion moves through society. New money does not fall from the sky equally. It enters through channels. Those near the channels get to use the new claims before the full repricing filters outward. Those far from the channels receive the higher prices later without having first received the strategic advantage. This is one reason why asset owners often seem to do well in inflationary or highly financialized eras, while cash savers feel increasingly cheated. The system is not merely creating money. It is redistributing timing, access, and political priority. Once you understand the dilution ladder, you stop hearing inflation as just an economic statistic. You hear it as a class process. The person with cash is standing still, while the person with assets, leverage, and proximity to credit is riding the escalator. That is why I always tell people gold is not mainly about catastrophe, it is about truth. Gold tells the truth about whether your currency still behaves like a store of labor or whether it has become a management tool for a far more elastic order. This is also why central banks themselves are so fascinating right now. Publicly for decades, gold was often treated as something archaic, a relic, a sentimental object, something that belonged to another era of finance, one too rigid for the sophistication of modern policy. And yet, what are central banks doing in the real world? Buying gold, accumulating gold, hedging with gold, diversifying reserves with gold. Why would institutions presiding over fiat systems keep accumulating a non-yielding metal if the metal had become irrelevant? Because irrelevance is not how they think. Public messaging and reserve management are not the same thing. When central banks buy gold, they are not saying, "We wish to return fully to a 19th century monetary order by Tuesday." They are saying something more subtle and much more important. They are saying that when trust, sanctions, reserve diversification, debt expansion, and geopolitical uncertainty all deepen, there is still no fully satisfactory substitute for a reserve asset that is no one else's liability. That sentence matters. Gold is no one else's liability. A treasury bond is someone else's liability. A bank deposit is someone else's liability. A currency reserve is someone else's liability. Gold just sits there. That is the fifth mechanism. I call it the liability escape. The liability escape is the role gold plays when institutions want to hold part of their reserves outside the political promises of another state, another bank, another treasury, or another legal order. This is especially important in a world of sanctions, reserve freezes, weaponized payment systems, swelling sovereign debts, and growing doubt about how disciplined large states will remain once their debt machines become culturally normal. Gold does not need to love you. It does not need to promise anything. That is precisely why it becomes attractive when too many promises have been made elsewhere. This is where ordinary investors need to be careful, because once they hear central banks are buying gold, they leap to the wrong conclusion. They think gold must therefore be a ticket to riches. Perhaps it will rise, perhaps it will not. That is not the first lesson. The first lesson is that gold is a monetary signal before it is a speculation. It tells you something about what the adults in the room think about reserve risk, currency dilution, and systemic trust. If you are mature, you will hear the signal before you start fantasizing about price targets. That leads to the next great confusion. Should you buy gold? That is a much less intelligent question than most people think. The more intelligent question is this: what role do you want gold to play inside your understanding of money and inside your balance sheet? If you buy gold because you think it is a tech stock with better branding, you misunderstand it. If you buy gold because you think it will produce cash flow, you misunderstand it. If you buy gold because you want to bet the farm on total collapse, you may misunderstand both gold and collapse. Gold is not your operating business. Gold is not your whole portfolio. Gold is not a substitute for productive assets. Gold is not a religion. Gold is a reserve. Gold is a hedge against dilution, fiscal indiscipline, trust decay, and the long habit governments have of slowly changing the terms under which savers are expected to live. That is the sixth mechanism. I call it the reserve function. The reserve function is gold. S role is financial insurance rather than financial ambition. Insurance is often misunderstood because people resent paying for outcomes that do not occur. But the value of insurance is not only in payout, it is in posture. It changes how exposed you are to a risk you cannot otherwise control. Gold can perform that role for some people and institutions precisely because it is outside the normal chain of managerial promises. It is not supposed to delight you every quarter. It is supposed to remain itself while other things change. That is very different from chasing returns. And once you understand that allocation becomes a matter of design rather than ideology. How much that depends on your worldview. Your other assets, your confidence in institutions, your time horizon, your tolerance for volatility, and your overall need for liquidity and yield. The point is not the perfect number. The point is the role. If you cannot describe the role, you have no business buying the thing in size. There is also the matter of how you own it. Physical metal is one thing. An ETF is another. Mining shares are another. Royalty companies are another. Futures are another. A person who says, "I own gold," might mean at least 5 very different things with very different liquidity, counterparty leverage, jurisdictional and psychological characteristics. Physical ownership offers one kind of certainty and one kind of inconvenience. Paper proxies offer one kind of efficiency and another kind of dependency. Mining shares can be marvelous businesses or disasters. But they are businesses, not metal. They introduce operating risk, management risk, jurisdiction risk, cost inflation risk, dilution risk, and all the human mess that bullion itself simply does not have. This is why sloppy gold talk is usually not worth listening to. One must be precise. Do you want money with no cash flow? Do you want exposure to the price of money with no cash flow? Do you want an equity claim on businesses that dig up money with operating leverage? Those are different ideas. Confusing them leads people to say foolish things like gold is dead, when what they really mean is that some mining stock disappointed them, or gold is going to save everything, when what they really mean is that they are frightened and want one symbol to carry too much emotional weight. I respect fear. I do not respect confusion. Now let us step back. Why does this topic matter so much now? Because the world has become accustomed to conditions that would once have been seen as extraordinary debt at astonishing scale. Central bank activism at astonishing scale, public promises layered on public promises, deficits normalized, interventions justified as necessary, asset support treated as prudence, fiscal deterioration discussed like weather, and a whole investing culture trained to assume that every crisis will eventually be met with some new form of liquidity, accommodation, rescue, or management. Perhaps it will. That is part of the point. The more the system demonstrates that it will do almost anything except embrace hard external discipline, the more valuable it becomes to understand something that still represents discipline. That is gold's philosophical value as much as its financial one. Gold reminds you that not all money is equal simply because it buys groceries today. Some money is a claim that depends on restraint. Some money is the restraint that distinction is becoming more important, not less. This is the 7th mechanism. I call it the truth signal. The truth signal is the message gold sends when official optimism and underlying monetary behavior begin diverging too far. Gold does not speak in press releases. It speaks in relative purchasing power. It speaks in reserve behavior. It speaks in what institutions do when they stop performing confidence and start managing risk. It speaks when ordinary savers discover that their money grew for years and still buys less. It speaks when asset markets inflate while the moral language around prudence remains aimed at the cash saver. When gold rises over long arcs, it is often not telling you that the world ends tomorrow. It is telling you that trust is thinning, and trust can thin for a long time before the public admits it. That is why understanding gold matters, even if you never buy an ounce. Because if you do not understand why gold exists, you will tend to accept every change in the monetary order as natural and every reduction in your purchasing power as just one of those unfortunate things. You will not ask the more dangerous questions: what exactly is my currency anchored to now? Who benefits when more claims are issued? What happens to savers in a system that keeps rewarding borrowers and asset owners first? Why are central banks diversifying into an asset they publicly treat as obsolete? Why does every era of intense monetary flexibility eventually produce a renewed respect for what cannot be printed? Those are adult questions. And adults who ask them are harder to fool. So let me finish with the central line. Gold is not asking you to worship the past. Gold is asking you to stop confusing a promise with a principle. A fiat currency can still function. A fiat currency can still dominate. A fiat currency can still be the cleanest shirt in the dirty hamper. But if you want to understand what it is, what it has cost savers, and why so many institutions still quietly reach for gold when the official story wobbles, then you must stop treating gold as a shiny curiosity. Gold is the mirror. Gold is the ruler. Gold is the witness that keeps showing up whenever societies grow too comfortable with the idea that money can be stretched without consequence and trusted without discipline. That is why every empire eventually ends up arguing with gold. And that is why the people who do not understand gold usually do not understand money until after money has already taught them the lesson the hard way.